This is John Dunleavy back with Monorail Investments, and I want to spend a minute talking about international equities. For the last 14 years, the U.S. equities have outperformed international equities. However, this year started to see a change, and one of the big reasons we saw this change is that the U.S. dollar has been slumping. Obviously, there's a big correlation there between how the US dollar performs and how foreign equities will perform. So when the dollar's weak, international equities tend to do better. The potential for outperformance this year really it came to light in April. April was the month where we had a severe market correction in US equities, and that was due to all this uncertainty about tariffs. We saw the S&P 500 get down into that 4,900 level. Currently we're somewhere around 6,600. So we've had a strong correction from that low. As I mentioned, the dollar now is at multi-year lows, and that's giving a lot of strength to international allocations. Now, I should mention, in terms of the overall global equity markets, if you include the US and all the world's equities, the US has a strong footprint. It's 65% or so is U.S. equities. So it's a huge part of the market. One reason to look at the market now, other than the weaker dollar, is just for basic market diversification. It might make sense right now, particularly with a weaker dollar, to allocate some money to international equities. And you can do this on Monorail with some foreign ETFs. Market diversification, in terms of allocations, I think 15% or so is probably appropriate. Beyond that, then it becomes really, you're making a bet on the US dollar. There's also an opportunity for faster growth now. Relative real GDP growth of India, for instance, is 4.4%, which is well above the US rate. Other countries like Saudi Arabia and Nigeria are also expected to outperform US growth. Could be, again, faster growth is often correlated with total returns and foreign stocks as well. You get a larger array of investment choices if you go international as well. Some of the top performers on the world market during the past 10 years, only 18% of the world's best performing companies were US based. So picking the right companies overseas can be a very profitable strategy. And then the US fluctuations, the currency fluctuations. Weaker dollar is always relative to foreign currencies often means that you can outperform when the dollar weakens. So these are really 5 reasons I think is a good time to look at it. In terms of potential disadvantages, people may say, well, why do you want to own foreign equities? Because you can just buy international exposure through U.S. multinationals. That's true, but there is a limit as to international sales on some of these companies. For instance, Intel, 78% international, Coca-Cola, 69% international, Apple, 61%, and then IBM, 53%. So, it's possible to put together a portfolio that has a lot of international exposure, but it's not the same as buying pure international equity exposure. So with that in mind, it's just something you may want to look at, adding some international exposure now, particularly the weaker dollar, higher dividends overseas than what you can get here in the US. And as I said, some of the top performing global stocks are international. So this is John Dunleavy from Monorail. Hope to see you in the next video.